Welcome, friends. Up to now, we have seen how to read annual report. Then we have seen how to read balance sheet, profit and loss account, this cash flow statement. So all aspects we have learned. Now it is turn of analyzing whatever we are able to read. For this analysis purposes, we do different sort of ratios analysis and depends upon that ratio analysis we come to some conclusion how the share is performing or a company is performing, whether we should have a stake or purchase share of that very company or not. So it is very important to analyze companies, and for this analysis is important different sort of ratios. Normally, we will discuss four type of ratios which is useful in our analysis. First is financial ratio. Under this financial ratio is profitability ratio, leverage ratio, valuation ratio, and operating ratio. This profitability ratio gives us picture how company is profitable, whether company is generating enough cash, enough profit, and company will be profit in longer term so that our investment will not stuck there. Company will not be in debt. So we know from this profitability ratio overall profitability of a company. Second thing is leverage ratio. How much company have taken leverage or debt? How company have ability to serve those debt or repay loans. If company do not able to pay debt, what will happen? Whether company might turn into defaulter, whether it will go to NCLT, our whole investment will stop. So this leverage ratio is very important also. Then third is valuation ratio, where we see apart from profitability and leveraging, whether valuation of a company is cheap or very high. We see company is profitable, leverage is okay, company is not having so much debt or very less debt. So is these two aspect okay? But third aspect is whether company valued is okay or overvalued. If overvalued, we have to think twice before investing. It is possible that company will not be able to give return as per expectation. So we have to see if overvalued, we have to wait till it is come fairly valued. Then coming to operating ratio. This is also important. It gives glimpse of how company is operating, whether company is able to turn whatever assets is there into profits, how company is able to operate and generate profits. So this operating ratio is also important. So all this part we will discuss one by one. Today we will take first part, that is profitability ratio. So under profitability ratio, we will discuss five important components. First is EBITDA margin, EBITDA, earnings before interest, tax, depreciation, and amortization. This is known as EBITDA. So we will first see EBITDA margin. This is also known as operating profit margin. Second, we'll see PAT margin, profit after tax. First is profit before tax, now profit after tax. Third, we'll see ROE, return on equity. Fourth, we'll see return on assets. Fifth, we'll see return on capital employed. So all five we'll discuss one by one. First is EBITDA margin. So let us go to screener.com. Here we see all this is here. This operating profit is nothing but EBITDA margin. So what is EBITDA? Earnings before interest, tax, depreciation, and amortization. So from where it comes, this is total sales or total revenue minus total expense. Whatever profit coming is operating profit or earnings before interest, tax, depreciation, and amortization. So from here we get ready-made template, ready-made data. So simply we can go here and analyze any one particular year. If we see, it will not give any perspective. If we compare this with 4 5 years earlier data, then it will give good perspective. Here we can see this operating profit from 257, this slowly increasing each year. This profit increase or EBITDA margin is increased till 2020, or we can say 21, then 22 little going down. And this percentage is here also. So it is almost consistent except 2022 where is 4% down. So this gives ample perspective. Company is sound. Only thing due to some reason this particular year not able to generate that much. We have already seen this 4% decline due to increase in material cost. So this gives ample perspective to this. Second is fat margin. We can see downside this profit before tax, then net profit here coming. So this is profit after tax. If we change this next column like profit, operating profit margin or percentage, we can calculate from here to how much we are getting. So this also gives consistent performance, wonderful performance. So this is very good also. So we can get ready-made. Another thing for discussion, we have created a template and just uploading here. And if we are exporting to Excel, we can get wonderful idea and can have details and explanations. So here we got and just open this one. So we see this ready-made data. Here we can see this sales growth, and from there, this operating profit, we can see this much we are getting. Same from Skinner we have downloaded. And just downside, this net profit and net profit growth we can see. Here we can see easily visible from earlier 1 year. In place of 646, net profit 511 crore only. So there is decline in profit. That is why it is advisable to stay away. Earlier there was good profit, but now there is no. So we can get net profit growth or net profit margin from here. Now, first thing is ROE, return on equity. This calculation is also done here. Return on equity, we can see consistent here, but this March 22, 4%, little more than 4% decline, clearly visible here. So return on equity, we can see. But one thing more I want to show you before coming back to this same return on equity is calculated as net profit by shareholders equity to 100. This 100 will give percentage, that is to return on equity, net profit. So from a screener, we can get easily the how much net profit we have, and this divided by shareholders equity, we get perspective. But there is one catch. For analysis of that catch, this DuPont analysis comes. Return on equity. For example, let us see, before going back again, any company gets 2,500 profit out of equity, shareholders equity of 10,000. So how much will be ROE percentage? 2,500 divided by 10,000 into 100, it will come to 25%. But if we tweak little bit here, in place of 10,000, we see company have shareholders equity only 5,000, and balance 5,000 is taken as a loan from bank or some friends or somewhere, and same 5,000 plus 5,000, total 10,000 employer and company getting same 2,500 return. So what will be return on equity? As shareholders equity is 5,000 only. So return will be 50%. How it is? 2,500 divided will be 5,000 only here, not 10,000. Because 5,000 balance is loan. So ROE will be 50%. So we will get confusing data to analyze better way to avoid this confusion. DuPont Corporation had done in 1920 some in-depth analysis. He broken down this same formula further, and then we are able to get further insight of company performance. This second part, this missing part, this how much leverage or loan taken outside, and that generated this profit, same profit, that will be come to know, and then we can decide whether to go ahead with our investment in that particular company. So same net profit divided by shareholder, that we broke down in three part. First part, this net profit divided into net sales, average total assets, shareholder equity. So we can see here this nominator, again this denominator. So it will cancel and ultimately come back to here, net profit, shareholders equity. So what this gives perspective. These two you take, this will come net profit margin. Second, net sales divided by average total assets. This will give asset turnover. And third, average total asset divided by shareholders equity. It will give financial leverage. So we'll come to know three aspects from same return on equity. And this will give further insight. Net profit margin will give how much profitability company is generating If we'll compare year by year, it will give trend whether this consistent performer or no. Second, how company is using asset, whether asset is generating enough cash or no. So asset turnover gives this insight. This financial leverage, this last part will give how much company is leveraged or how much loan company has taken. So this part will discuss this one. And from there, we come to know, like our example, these 5,000 loans will reflect here and will come to know whether this company is over leveraged, less leveraged, and accordingly we can decide. So let us go to our example here. This same thing is here we have discussed. This first is net profit margin. So we are getting here this calculated. We can see this 9, 7.78, 7, 9.66, 9. Let's come back again, 5.88. So consistent performance, 7.8 or 8%. Not great performer, but okay, we can see consistent performance is there. Asset turnover is 1.48. It is okay. Not much great, but it's okay, good. But financial leverage is also good. If financial leverage, as I have clearly mentioned, is four or more, then we must avoid. Some people take up to three, some take it up to 2.5%. If less than 2.5%, it is good. So from here, this calculation, we clearly can see these three parts, whether this is okay with us or not. And from this, ultimately, we have return ROE, we have calculated. So we come to know all this. Now this last part, ROCE, return on capital employed or total is how much they are giving. So we'll go to a screener and here we can see downside. Yes, ROCE clearly mentioned. So from this figure, we can get how much each company is giving. Here again, we can see from here to here, this 6% downside, and we can see all this consistent. But now company have not performing, especially up to March 22, is not good performance. It is going down. So we should be little cautious before investing in Amarada battery. So from here we can get, so all aspect we can see from this screener.in. Even we can go to money control or any other website where we can get all this data and we can easily analyze. We can go to annual report, but there we might not get all data year by year. So better to go for a screener and there we will get data and all things explained. Tomorrow we will see leverage ratio, see how company have taken loan and whether we should go ahead with investment or no. If you find some value, please like this channel and subscribe to this channel and share with your friends and colleagues so that they can also get benefit out of this. Thank you.